Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast, and you are in for a treat. There is so much happening in the world right now with the economy and property. We react to the budget, we give you a mortgage market update, talk about interest rates, house prices, and so much more. And even, as you'd expect, a few rants. It's a cracking episode coming up.
Welcome to the Property Podcast. Thank you for joining us. We've been doing this podcast for nearly 10 years. We've been active in the property industry for much longer than that. And this last week has been up there with the maddest weeks we've ever seen. There is an insane amount going on. We'll be breaking it all down for you and talking about what we're doing in this market as well. That is coming up. But I don't think this week is going to be the end of it. There's going to be a lot to talk about over the coming weeks and months. So now would be a great time to make sure that you are following the Property Podcast to make sure you get every episode sent direct to your phone. So on Apple Podcasts, hit the little plus button. On Spotify, hit follow so you don't miss an episode, because right now is a time when you need to know what's going on.
So before we get going, you may have noticed that this is episode 499. So we have a very special episode coming up next week, episode 500. We are nearly 10 years into this. This is absolutely bonkers. Episode 500 is an incredible milestone because we've not missed a single week in those 500 episodes. And to celebrate, we're taking a week off. No, we're not really. We're doing something out of the ordinary though, Rob. We're not taking a week off, which would be out of the ordinary, but we're going to do something else that's a little bit more valuable to our whole community.
Yeah, it should be a lot of fun. So we are going to be recording episode 500 live on YouTube. So we try not to do stuff on video. We try not to do stuff unedited. We're doing both of those things. This is the first time ever you can actually watch us record a podcast live on YouTube. It'll be broadcast next week as episode 500, but we're recording it tomorrow because, let's be honest, our editor's going to need a pretty long run at this. So you can join us tomorrow. That's Friday the 7th at midday, and be there in the chat, interact with us and watch us record episode 500. And all you need to do is subscribe to our channel on YouTube, so that'll be available to you. So just go to YouTube, search Property Hub, make sure you're subscribed to our channel and hit the notification bell, because then you'll get an alert when we go live.
It's going to be a lot of fun. We'll be answering your questions, and there's a fair bit going on in the world. We will obviously be covering that, and we'll also field questions about the pod. We've been doing it for a long time now, so what would you like to know about the podcast? And, of course, we might answer the odd property question as well, so make sure you join us for that. And as Rob said, not only subscribe to the Property Hub channel, but do make sure you set the notifications up so you do not miss it. Because I get the feeling we'll only ever do one live episode. I'm already feeling pretty confident about that. So make sure you do not miss it, turn on the notification bell, and as soon as we go live, you can join us.
Time for market update, and wow, there is so much going on. This is our monthly market update. We could easily make it a weekly market update. Last week's episode we recorded 3 days before it went out, and already parts of it were out of date by the time it did. There's so much going on, it's really hard to keep up. So in this episode, we are going to guide you towards what we believe are the most consequential things out of all of that you need to know about as a property investor, and give you our take on what it all means. And at the end, we're going to talk about what we're personally doing in response to everything that's going on at the moment.
Now, to start with, I'd highly recommend you listen to last week's episode. So even though parts of it were out of date, what we did do is cover the budget in quite a bit of detail and our reaction to it. And spoiler alert, we felt it could be a great and awful budget all in one. And if you want to understand why, then go and listen to that episode. Because depending on your point of view, it will be either great or awful, and probably not a lot in between. What's interesting is we'd question the 45p tax band removal, but the tax band removal has been removed, or reversed I should say, and they are no longer doing that, Rob. And when you found out, you were a tad perplexed. Not because you felt you were taking a big tax hit, but just perplexed at how our government is operating at the moment.
Yeah, I said it was stupid. That's what I said, because whether you agreed with the policy or not, they've already come out and said, while trying to justify it, look, it actually makes very little difference in terms of how much tax is collected. And they've already justified their reasons for doing it. They believe it simplifies the tax system, it provides stronger incentives to work and create jobs and things like that without affecting the tax take. They may be right or they may be wrong, but the point is they've already taken a week of heat for everyone hating this. So they may as well have just ridden it out. Memories in politics are pretty short. I don't see the point in doing something that you believe in and think is a good idea, take a load of heat for it for a week, and then go, actually, we're not going to do it after all. You might as well just carry it on, because now they've got the worst of both worlds, and they've been put in this position of having to back down and look weak. I think the mistake that they made was kind of reading the room wrongly to start with. They couldn't have realised how bad the response to this budget would have been. Otherwise, they would have approached it differently. But having done it, it's done. So for me, I think this reversal takes a mess up, which was putting out this set of policies without an awareness of what it would trigger or doing anything to mitigate that, and then compounding it with another mistake by just looking weak.
I completely agree, Rob. And to repeat, it's not about us being in favour or not in favour of the policy. It's just the message it sends, because now, understandably, people would question, well, if you've got that wrong, what else have you got wrong? So it then brings the whole budget into question, which the markets have been doing quite well over the last week as well. And the real story of the budget wasn't the budget itself, it turned out, but the reaction to the budget, which you've already touched on, Rob. And the pound took an absolute hammering after the budget was announced, and the markets basically said, we do not like this budget. This budget is not good for the longer-term economy of the UK. Now, before we get into our reaction of the markets and what's played out, I think, Rob, in case someone's been living under a rock for the last week, let's give them a quick update of exactly what did play out.
So I'll try and explain this simply without oversimplifying it. But basically, as we've already said, the markets hated this budget. And it seems like the main reason that they hated it is that the government was cutting tax, so less tax coming in, which would then mean more borrowing would have to make up the gap. So as we've already said, the markets hated this budget. And the main reason they seemed to hate it was that it's going to result in a lot more borrowing. So the energy cap, we already knew about that, and that was obviously going to involve a lot of borrowing, because they need to go to the markets to borrow the money to give to the energy suppliers to keep everyone's bills down. But that we knew about. But then on top of that, there were these tax cuts. Even if there are good reasons for doing them over the longer term, immediately means less revenue coming in, which means unless you cut spending, more borrowing to make up the difference. And this basically spooked the markets. They were looking at the government going out and needing to do all this future borrowing, which is going to mean a greater supply of government bonds on the market. And as a result of that, two things happened. First one is people sold the pound. They felt less confident about the prospects of the UK, so they sold the pound, which reduced its value relative to the dollar, and the value of the pound plummeted, which scared everyone. Also, the debt market lost a lot of confidence. They looked at what was going on and realised they weren't very comfortable owning government debt anymore, or not as confident as they were, especially because there'd be more supply of it coming onto the market soon because of all the extra borrowing. Therefore, there was a sell-off of bonds. And when that happens, it pushes up the yields on those bonds, which pushes up the price of government borrowing. So basically, there's a lot of interaction between all this different stuff, all triggered by a loss of confidence, the result of which was that the government not only going to be needing to borrow more, but the cost of that borrowing was possibly going to be higher than they expected because of bond yields increasing. And because of all these factors interacting, and because bond yields increased so rapidly as a result, it then had a knock-on effect into something that most of us had never even given any thought of until this happened, which is pension funds.
Now, explaining what's exactly happened with the pension companies and why they've come under so much pressure is a podcast in itself, or a YouTube video. Now, we've not got time to do a whole podcast on this subject just yet, but fortunately, a YouTuber that Rob and I both follow has done a great job on this. And the video you want to watch if you want to get more detail is by Patrick Boyle. I'm pretty sure we've mentioned him on the podcast before. The video is called Pension and Mortgage Chaos in the UK. So if you search for that plus Patrick Boyle, you'll find it, but you'll also see the link in our show notes. It was actually quite serious what played out, and the results could have been catastrophic. So then the Bank of England had to step in, and the Bank of England already stepped in to talk about interest rates and what they would be prepared to do, and more on that in a moment when we get to mortgages. But the Bank of England have also effectively started QE again by buying long-term government bonds. You may have also heard this referred to as gilts, but it's the same thing. Now, this is an unusual move, but in an inflationary environment, which we're in right now, a big part of what's going on in the world and why so many economies are struggling is because of high inflation, something we've not even got to yet in the podcast, which is crazy. You would not expect to see QE because effectively QE is a contributing factor to inflation. And it's the type of QE you do as well. Again, this is a big topic, and I'm sure we'll come back to this in the next few weeks. But QE is quantitative easing, and the easiest way to describe quantitative easing is it's like printing money. You don't physically print money, but it's money creation into the system. So basically, the Bank of England created money out of thin air to buy these bonds. And they didn't just buy a couple, they bought £65 billion worth. So that's a lot of money that's been created that wasn't there before to buy bonds that was not needed a week before. So much has happened right now. I appreciate this is a lot to take in, and Rob and I read all this stuff day in, day out and absorb it and try and give you the nuggets, the headlines, and hopefully this is coming across. But we honestly have had to cut so much news out today. This could have been a 2-hour podcast. There's so much happening right now, but we're just trying to take you through the biggest bits, the most important bits, and the bits that are going to impact you. And while the pound falling and that QE taking place is very newsworthy and will impact the economy, it doesn't really impact you day to day. And actually, Rob, I want to focus on this because it's so important. We did a webinar last week, which was amazing. And I really hammered on about not focusing on the media because the media absolutely went to town on the pound falling. And it did. It went to an all-time low. But what's not been reported is it's recovered. And as we record this, the pound now is 112 to the dollar, which is what it was at pretty much before the budget. You had all the big scary headlines about the pound collapsing, not really explaining why it would affect us day to day or why you should be scared, but just that you need to be scared. So everybody themselves, and then it's gone back up, recovered to where it was before. Not a murmur. Nothing. No, good news, pound's recovered, everyone calm down. Now, that doesn't suit the agenda, that there might actually be some reasonably good news, and actually it's not as bad as everyone thought, and the pound didn't go to parity, and it's bounced back. Now, it may drop again, but my point isn't the movement of the pound against the dollar. My point is the negative influence the media has on your lives. It's incredible. So while we are going through the news here, something I really want to get across is really check yourselves when consuming the media. Yes, the pound moving is interesting, but it doesn't have to be scary. And for most people, it's not going to impact you, certainly in the short term. So don't let it worry you. And don't let most of these headlines worry you, because we've been through crisis after crisis after crisis. In the middle of a pandemic, that was pretty scary, right? But we're here now. Yes, terrible things happened. But if we can survive a worldwide pandemic, we can also survive a negative reaction to a budget. That's all it is, really, isn't it? A negative reaction to a budget. When you say it like that and put it into perspective, it's kind of a lot less than some of the things we've been through in the last 10 years.
And you know what? I didn't even know that the pound had recovered that far. I knew that it stopped falling and it had come back a little bit, but I'd completely missed that it was pretty much back to where it started before all this happened, because like you say, it just hasn't been reported anywhere. And the other reason I hadn't noticed is it doesn't affect me, like it doesn't affect most people day to day, which also ties exactly back into what you were just saying. But this all ties into something that does affect listeners of this podcast, which is mortgages. And the other big story of the last week has been the number of mortgage products that have been pulled from the market. So the headline that we've linked to says nearly 300 deals pulled. It then went up to 1,000. I've got a feeling it may have ended up being 1,600 in the end. It was a lot. A lot of mortgage products got pulled from the market. And this made a lot of headlines. It's very prominent on the BBC. A lot of people were contacting me about it. And that can, of course, be really bad news, depending on where you are in the buying process. So if you were just about to put in an application and for some reason you needed to put in that application really quickly. So let's say you're a first-time buyer, you've just found your dream home, you've done all your numbers, you can just about afford it, it just about works for you based on this handful of mortgage products, and then suddenly they're all pulled. You currently can't proceed with your purchase, you don't know if those products are coming back, and you don't know at what price they'll be coming back, and if that property you were going to buy will still work for you. That's bad. But Rob, I think this is another one that we need to put into context, because I think it's very easy to leap to the interpretation of, oh no, mortgage lenders are so scared by what's happening in the markets. They think property is going to crash, therefore they're not willing to lend anymore. But if you actually go and look at the reasons for what happened, it's a little bit less scary than that.
It is. And there's a really good piece in the FT where they've covered this and the reasons behind it, not just the headlines of what's happening. So this all began when the Bank of England, in an effort to stabilise the pound and bring calm back to the markets, went out and said, we're prepared to move interest rates up aggressively and before our next scheduled announcement. It didn't look like at the time it had much impact on the pound, but it did have a huge impact on the mortgage market, because suddenly lenders were spooked. And the reason they were spooked is they anticipated a surge of people trying to lock in fixed rate products. Understandably, right? You'd want a fixed rate if you think interest rates are going to go up, particularly if the Bank of England have made an unscheduled, scary announcement. So the first to make a move on this was the smaller lenders, so lenders like Atom Bank, Virgin Money, because they are far more vulnerable to surges in the market. So they removed their fixed rate products, which then in turn put pressure on other lenders, particularly the smaller ones, to be not the last lender standing. But the last ones in the market were the big lenders, but because all the smaller lenders by this point had moved out, they then had to remove their products. So it was a knock-on effect. It was a domino effect of panic. And you can understand how the panic started. Now, spectacularly, at least I think it's spectacular, the Bank of England have indicated now that they will not raise interest rates before its next scheduled announcement. So we've had all this turmoil in the mortgage market and for lenders in general, with the Bank of England making this statement that didn't seem to impact the pound at the time anyway. And now they've come back and said, well, actually, we're going to wait till our scheduled time in November, when they are forecasted to raise interest rates. But that's okay for lenders because lenders know when it's going to happen and can make adjustments accordingly to that timetable. What they can't do is make plans and adjustments if the Bank of England threatens to come out at any point and raise rates. And that's why the panic was caused. So what should you do and what will happen over the next few weeks and months? Well, hopefully now the Bank of England have indicated that they're not going to actually do anything until November. The markets can resettle, reprice their products and release those different products to the market. Yes, of course, they'll be slightly higher than before, but that's because the Bank of England is expected to raise rates on November 3rd. So, at the moment, unless you're forced to, do not worry about making changes to your mortgage or trying to get a product in place. Only do that if you're absolutely forced to. The best thing you can do over the next week or two is do nothing. Yes, if you're on a standard variable rate, maybe you have to pay more for one extra month until the markets settle again. But I'm in that position and I'm just waiting for the markets to settle. And then once they've settled and we know what we're dealing with and the lenders can introduce the products back to the market, then it's a much better time to lock in a product. So don't do anything for the next 2 weeks while this turmoil calms down. And it is starting to calm down already. And then you'll be in a much better place to make a better informed decision.
That's right. I think it's tempting to go, oh my goodness, they're going to come out and raise rates again, therefore I need to get in now. But mortgage rates, as well as the base rate being a factor, are priced off long-term bond rates as well. And something called the swap rate, which is insanely boring, is important when it comes to this. And that is something that's been all over the place over the last week because of everything that's been going on. And that has started to settle down. So while it's tempting to think, I need to do something right now, actually, it's far better to wait for the market to settle down, to wait for lenders to figure out what they're doing again, get a full product range back. Then you'll be in a stronger position to take action and make decisions like how long you should be fixing for.
Now, with all this turmoil, and there is a lot, right, you will then naturally start to think about property prices and what is happening there. And with all the scary news, which we've kind of said already, don't be so scared by, and even headlines predicting or stating that there's a house price crash, we're in a falling market. Well, no, we're not actually. Unfortunately, the data doesn't back up the headlines. And the market experience that we have day to day doesn't back up those scary headlines. Is there a slowdown? Yes, but we were having a slowdown before the last fortnight played out. So, Rob, what is actually happening? Beyond the headlines, what is playing out?
Well, we don't know what's going to happen in response to everything that's happened over the last week, and we don't know where mortgage rates are going to settle, and that's going to be an important factor. But what we can do is look at what's happening right now. And if we do look at what's happening right now, there's a couple of things that I think are of particular interest. The first is that more property listings are posting reductions from their original asking price. So there are more reductions now than there were 3 months ago, 6 months ago, a year ago. That is not a surprise. That is a sign of a cooling market, which we've been talking about extensively over the last couple of months. But the proportion of reductions is only back to 2019 levels. And 2019 levels are, interestingly, actually a bit lower than 2018 levels. So the point is, it's not like that suddenly everyone is panicking and slashing their prices. It's just that for the last couple of years, the market has been so bonkers that hardly anyone has needed to reduce their prices. And now it's coming back more towards a normal market. And that's something we talked about in our recent YouTube video. Because the market is cooling, there are reductions and there is a possibility to go out and negotiate a deal. Not saying that it's easy now, but it's functioning more like the normal market that we were used to in 2019 and before. The other point is around demand. Naturally, demand is going to be reducing as people are concerned about the cost of living, concerned about mortgage rates, etc., etc. And demand has fallen from the peak. But again, it's still above its 5-year average. So the pattern that we're seeing here is not a market in free fall or anything like that. And prices over the last month, according to Nationwide, were flat. So prices have risen by, according to HomeTrack, 8.2% over the last year. They're not falling. And there's no panic in the market, but it just feels different because we've been used to an abnormal market for the last couple of years. I think it's important to say that prices can fall. And if we do see a month-on-month fall before the end of this year, I wouldn't be shocked. But you've got to put it into context. You don't buy something expecting the price of it to just go up in a straight line forever. And you don't hold off from buying something if you're buying it for the long term because the price of it may dip for a little bit. It's very difficult to say what's going to happen with house prices month to month over the next little bit because everything that's going on is so crazy. But I think you just have to look back to the underlying patterns of supply and demand. And like I've just mentioned, although we've seen the heat come out of the market, which I think is actually a good thing, that's looking pretty healthy.
So hopefully you feel a bit different now after hearing that, because that's not really being reported anywhere else. House prices not falling and are up over 8% year on year. Not much of a headline grabber, is it? And like Rob said, it might have a negative month. And if it does, wowzers, wait for the media to get hold of that. But over the long term, we're still pretty confident. And actually, towards the end of this pod, we'll talk about what we're doing right now. Before we get there, Rob, let's wrap up with a few other quick stories. The first of which is rents are still rising. The rate of growth is slowing, and this is according to HomeTrack, the report that they've put out recently on the rental market for the third quarter this year, but still going up. So rents are increasing, and that's a trend that we've been seeing for a long time. So as mortgages for a lot of investors at the moment are on the up, then having rents on the up as well is helpful. You can offset some of that, or maybe all of that cost, via the rental market pushing on. Obviously, not so great for renters, but all of us are paying more at the moment. So having the rents increase means that actually, on paper, property and the returns we get are still pretty much where they were a few months ago because the rents are doing quite well and remaining strong.
Yeah, the strength of rents is really good news for investors, and actually loads more that we could say about the patterns of rental demand. But we need to move on to politics, because we've talked about the week's big news story when it comes to politics, but there are actually some stories that would have been massive headline grabbers in any other week, but have gone completely under the radar because of everything else that's been going on. The first is that Labour has had its party conference, and what Labour thinks about housing could become relevant given what the polls are looking like at the moment. And they've had their conference where they've laid out something that they're calling their Renters' Charter. Most of that is pledging things that the current government has already said it's going to do, but there are a couple of other bits in there as well. One of them is it wants to take notice periods to 4 months rather than the current 2, and they want to end mandatory evictions for rent arrears. So currently, if a tenant has got a small amount of rental arrears and you try to go to court to get an eviction order, it's up to the judge whether they grant that or not. But when arrears get to a certain level, they have to give possession. Labour wants to end that. There's so much we could say about all of this, Rob, but we're running long. Maybe this will be one to come back to in the future, but certainly a couple of things in there that property investors won't be happy to see.
Not that The Guardian will care, Rob. And that is our, and finally, news story of the day. And let me read you a headline from The Guardian. Selling up and raising rents, how landlords are cashing in and exacerbating the cost of living crisis. So landlords, you're just ruining it for everyone. So first of all, you're putting up your rents. Yes, I know mortgage costs are going up, but you've just got to burden them, okay? You need to be hit by those rising costs. That you can't raise your rents. But if you think, you know what, I want to get out of this market, how dare you? Because you are now causing less stock to be available because you're leaving the market and you are now taking your properties out of the rental sector, making it harder for tenants to find properties. So basically, you can't win either way. It's a how dare you if you stay in the market, and it's a how dare you if you leave the market. But the thing is, and if Ruby from The Guardian is listening, If you hate something so much, anything in your life, then it tends to leave. And if landlords continue to be hated on continuously and aggressively, and they do leave the market, then that is only going to hurt renters. Only going to hurt them, because there'll be less stock there. Why will landlords want to put up with abuse on an ongoing basis and harder conditions to work in? Here's the truth, right? Landlords don't get rich from renting out properties. They may be able to generate long-term wealth. And in the majority of cases, they may be able to provide themselves a pension in the future and pass something on to future generations. I don't think that's a bad thing. And they also provide houses for people, and people need to rent. And some people choose to rent. My podcast partner, for example, he chooses to rent. Renting is not a low-life activity that we must all suddenly never want to do and only want to own homes. Yes, some people want to own their own homes, but it's not landlords stopping them, although you would think so from the headlines. So I like to think on the pod, we're pretty balanced when it comes to policies, politics, how society should operate, how the rules of the game are unfair, and we talk about that a lot. However, vilifying landlords is not going to help society. Most landlords are good landlords. Most landlords provide good homes. Yes, there is the odd bad one, but there is the odd bad person acting in every sector of every walk of life. And just because there are a few bad landlords doesn't mean that we should constantly abuse and pick on landlords. Rob, I think we're probably going to be lonely voices and standing up for landlords, and I feel it's probably been overdue for us to do it. But this story and this headline is ridiculous.
It is ridiculous, but it is but one story. I think pretty much every day The Guardian has a very similar story with a very similar headline, with a very similar story of one person whose details have been anonymised having a crap time of it. And you know what? I'm sure it's not hard to find one person a day who's having a bad experience with a landlord, but it wouldn't be hard to find one person having a bad experience with a lot of things, like you've just said.
I'm having a bad experience with The Guardian, Rob.
But there you go. But I'm sure those stories get clicks, which is pretty much the name of the game and ties very much back into the warning about the media, which you gave earlier. So that's a lot, right? We've been through a huge amount and we've cut out far more than we've kept in. This could have been triple the length very easily. How do we wrap it up? Well, probably the best way to get an overall impression of how we feel about everything that's going on is not what we're saying, but what we're actually doing. So as well as advising a fund, as well as arranging hundreds of transactions a year for our investors, we are investors ourselves. So Rob, for you as a private investor, as an individual, forgetting everything that you do in business, how are you responding to the madness of everything that's going on right now?
Well, obviously I'm investing. And you may expect that to be the answer all the time. But actually, it's not the case. I've just invested in a property, but that's the first one I've done this year. Because actually, the first half of this year was too bonkers for me. And what I mean by bonkers is property prices were surging. It was hard to transact because people were getting gazumped left, right, and centre. Estate agents weren't acting really that well. Not everyone, of course. There's some very good estate agents out there. But there are plenty of estate agents who were very much milking this situation and making it hard for people to transact unless they were willing to act immediately, possibly without even viewing a property. So it was just an all-round crazy time. And, of course, you have to work harder in that market to get a deal. Now, you can get a deal like you could in the first half of the year, but it's just not as hard work to get a deal. And I use Property Hub Invest to do that deal because obviously I'm busy, so it works perfectly for me. And if you're interested in Property Hub Invest, check it out on the Property Hub website, and I'm very happy. But Rob, am I a lone wolf in this endeavour? Am I just a crazy individual operating on my own? Or do you know any other people doing the same?
Well, no, you're in good company because I'm buying as well. I'm also doing a deal through Property Hub Invest. I've also got another transaction going through right now, which is a few weeks ahead. But again, this is the first time I've been active this year because I had just been put off by how crazy everything was. Not because it's like, oh my goodness, this is a bubble, this has to end, but just because, well, it's just too difficult. It's just too hard to operate under these conditions. But I've now got a couple going through. Producer Dan, who's also on this call, has got one going through. And we asked our YouTube community if what was going on was making them rethink their decisions. And some were. A third said it's put them off investing. Some saying it's making them more nervous than they were, but they're still doing it. Others still carrying on. But the other 2/3 carry on as normal. So Rob, no, you're not alone. I don't think it's just the two of us either. I think if you actually peel back the headlines and look at what people are actually doing, there's a lot of people doing what we are. Maybe we're unusual because we actually get excited when everyone else is getting nervous and the headlines turn bad. But in terms of behaviour, don't think we're alone.
Now, just because we're investing doesn't mean you should. But just because the media is scary doesn't mean you shouldn't. You should look at your long-term investment plans and continue to make progress towards them. We feel at the moment the market is in a good place, and it's in a good place for the next few years. And now it's easier to operate while so many people are scared. And it's a great time to get yourself a deal. It won't last forever, but a bit of turmoil, a bit of fear allows you to operate in this market and get a better deal than you could have even a couple of months ago. So do push those offers. Not everyone will say yes, but if you put enough offers out there and push it enough, a good deal, maybe even a great deal, will come your way. Now it's time for Hub Extra, the part of the show where we like to give you that little bit extra, that little bit more. And with so much going on in the world right now, Rob and I have been doing more live webinars. We normally do one a month. So the good news is if you go to propertyhub.net/webinar, you can see when our monthly webinar will be and sign up and join us. But because of the turmoil and the noise and the media playing up over the last few weeks, we've decided to do them a little bit more regularly. So to find out when our next one is, before we go back to our monthly format, go to propertyhub.net/webinar and join us for our next webinar. And we do a live Q&A every episode, so we get your questions answered. We get to the things that are important to you, and we have loads and loads of people turn up. So it's a great experience. So make sure you join us for one of those webinars in the near future.
Well, that's us done for today. A lot of ground covered. We'll be back again with a podcast next week for episode 500, but you don't have to wait that long. You can join us for the recording of that and get involved live. That's happening tomorrow, Friday the 7th, midday. Just make sure you're subscribed to us on YouTube and you've got notifications on so you can take part in that. So hopefully we'll see you then. And if not, we'll see you again next week. Bye-bye.
Bye-bye.